Hello, good afternoon all. I'm Dr. Preeti Varshney, co-head Management Department in Institute of Professional Excellence and Management, Ghaziabad. Today I'm going to discuss the topic capital asset pricing model and it comes under the subject financial institution and investment management FIN. So basically, the capital asset pricing model describes the relationship between systematic risk or the general perils of investing and expected return for asset, particularly stocks. So it is a finance model that establishes a linear relationship between the required return on investment and risk. So the model is basically based on the relationship between an asset beta, the risk-free asset rate, typically the treasury bill rate, and the equity risk premium or the expected return on the market minus the risk-free rate. So basically, CAPM evolved as a way to measure this systematic risk. It is widely used throughout finance for pricing risky securities and generating expected returns for assets given the risk of those assets and cost of capital, basically. So what are the various key takeaways of this concept? The first one is that the capital asset pricing model or CAPM is a financial model basically, and that calculates the expected rate of return for an asset or investment. So CAPM does this by using the expected return on both the markets and a risk-free asset and the asset correlation or sensitivity to the market beta. So there are some limitations to the CAPM, such as making unrealistic assumptions and relying on a linear interpretation of risk versus return. So despite its issues, the CAPM formula is still widely used because it is simply and allows for easy comparison of investment alternatives. So for instance, it is used in conjunction with modern portfolio theory, MPT, to understand portfolio risk and return. So basically, a summary of capital asset pricing model is that it is a mathematical model that estimates the expected return of an investment based on its riskiness relative to the rest of the market. So coming to next slide. So basically, investors expect to be compensated for risk. So here we see the formula of CAPM model. So this is the formula of CAPM model. And you see here, the investor expect to be compensated for risk and the time value of money. So the risk-free asset rate in the CAPM formula accounts for the time value of money. And the other components of a CAPM formula account for the investor taking on additional risk. The goal of the CAPM formula is to evaluate whether a stock is fairly valued when its risk and the time value of money are compared with its expected return. So in other words, by knowing the individual part of the CAPM, it is possible to gauge whether the current price of a stock is consistent with its likely return. So you see here, the formula is that expected return on security equals to risk-free rate plus beta of the security multiply by the uh, expected return of the market minus risk-free rate. So this is the formula of capital asset pricing model. So the beta of a potential investment is a measure of how much risk the investment will add to a portfolio that looks into like the market. If a stock is riskier than the market, it will have a beta greater than 1. If a stock has a beta of less than 1, the formula assumes it will reduce the risk of a portfolio. So a stock beta is then multiplied by the market risk premium, which is the return expected from the market above the risk-free rate. So the risk-free rate is then added to the product of the stock beta and the market risk premium. So the result should give an investor the required return or discount rate that they can use to find the value of an asset. So the problems with the CAPM basically it assumes unrealistic assumptions. So several assumptions behind the CAPM formula have been shown not to hold up in reality. So modern financial theory rests on two assumptions. Security market are very competitive and efficient, and these markets are dominated by rational risk-averse investors who seek to maximize satisfaction from return on their investment. So as a result, it is not entirely clear whether CAPM words the biggest sticking point is beta. So including beta in the formula assumes that risk can be measured by a stock's price volatility, and however, price movements in both directions are not equally risky. So look back period to determine a stock volatility is not standard because stock returns and risk not normally distributed. So estimating the risk premium. The next point is that as how we estimate the risk premium. So the market portfolio used to find the market risk premium is not is only a theoretical. So value is not an asset that can be purchased or invested in as an alternative to the stock. So most of the time, investors will use a major stock index like the S&P 500 to substitute for the market, and which is an imperfect comparison. So most serious critic of the CAPM is the assumption that future cash flows can be estimated for the discounting process. If an investor could estimate the future return of a stock with a high level of accuracy, then the CAPM would not be necessary. So the next point is that the CAPM and the efficient frontier. So you see in this slide, so using the CAPM to build a portfolio is supposed to help an investor manage their risk. And if an investor were able to use the CAPM to perfectly optimize a portfolio return relative to risk, it would be exist on a curve called the efficient frontier, as shown in the following. So the graph shows how greater expected return, y-axis, require greater expected risk, x-axis. So modern portfolio theory, MPT, suggests that starting with the risk-free rate, the expected return of a portfolio increases as the risk increases. So any portfolio that fits on a capital market line, CML, is better than any possible portfolio to the right of that line. So, but at some time point, a theoretical portfolio can be constructed on the CML with the best return for the amount of risk being taken. So you see in this slide, so you see in this slide, the CML and the efficient frontier may be difficult to define, but they illustrate an important concept for investor. So there is a trade-off between increased return and increased risk, because it is not possible to perfectly build a portfolio that fits on CML. So it is more common for investor to take on too much risk as they seek additional return. So in the following chart, you can see two portfolios that have been constructed on fit along the efficient frontier. So the next point is that CAPM and security market line. The efficient frontier assumes the same thing as a CAPM that and can only be calculated in theory. So if a portfolio existed on an efficient frontier, it could provide maximum return for its level of risk. However, it is impossible to know whether a portfolio exists on the efficient frontier because future returns cannot be predicted. So there are some assumptions behind the CAPM model. So I'm discussing all these assumptions with you. The first one assumption and foremost assumption is that all investors are risk averse by nature. The second assumption is that investors have the same time period to evaluate information, and there is unlimited capital to borrow at the risk-free rate of return. Investments can be divided into unlimited pieces and sizes. There are no taxes, inflation, or transaction cost. Risk and return are linearly related. So these are all the assumptions behind the CAPM model. So the bottom line is that in the last, we can say that so we can say that the CAPM uses the principles of modern portfolio theory to determine if a security is fairly valued, and it relies on the assumption about investors' behavior, risk and return distributions, and market fundamentals that don't match reality. So, however, the underlying concept of CAPM and the associated efficient frontier can help investor to understand the relationship between expected risk and reward. So, as they strive to make better decision about adding securities to a portfolio. So that's all about the CAPM model. Thank you so much for listening patiently, and thank you.